Good morning, traders and investors. Today is Friday. It's the end of the first week of the year. It is actually January 8th, and I wanted to wait to do this report. I wanted to wait for the employment numbers to come out. Well, we cut 140,000 jobs. Consensus was adding 50,000 jobs, but we actually cut. So the consensus was cutting 50,000, adding 200,000. We cut 140,000. This is very, very bad. And the unemployment rate is at 6.7%. So the unemployment rate is pretty much on the dot, but the non-farm payroll is lower. That's a bad number. And that's telling us that that COVID is having another major impact, as I expected, which may impact stock prices. Not long term, but short term. Now you got to consider the fact that the market is extremely bullish because there's a good chance with Democrats running the White House and both the Senate and the House, they're going to pass that $2,000 bill check to people, and give more aid. But I'm telling you right now, the economy, folks, it's like a balancing act between the administration propping the market higher. It's like a balloon. And this balloon wants to fall to the ground, and we're propping it up like this. But I'm going to tell you, folks, after a while, those arms start getting tired, okay? So, again, this is a bad number. Now, the market was above, just to show you the high, we're at 31,036. We went as high as 31,148 before this news came out. So we're cooling off a bit. But again, NASDAQ is doing really well. The S&P is doing well. Even the Russell's doing well. I'm keeping my fingers crossed that this rally will not fade because so far, most of the rallies, minor to small caps, have been fading. Now, interest rates. This is the 10-year, this is the long-term, 20-year plus Treasury bond. Now, this has inverse relationship with interest rates. When this breaks down, that's an anticipation that interest rates will go up. Now, the Fed has made promises that they will not raise rates, but remember, the market always prices in everything ahead of time. With Democrats taking control of the White House, there's a pretty good sentiment that over time there's going to be a pressure to start raising rates. So that's why this is breaking down. Again, this is an inverse relationship with the stock market, with the bond market, with the interest rate market. So again, bonds go down, interest rates go up. Interest rates go down, bonds go up. Well, interest rates have been going down, and bonds have been going up. But for the last year, we've been kind of treading sideways. This breakdown means that there's a good chance that sentiment over time on long-term rates, like interest rates for homes, cars, and so forth, will begin ticking higher or at least not going lower. So keep an eye on this breakdown. I think it's going to sustain itself at least to the 140 level. We may go back into the range, but there's a good chance we will hit 140. Going below 140, I think the Fed will have to make some moves, and I'm not sure they're doing that right now. Now, in terms of global economy, global shares rose Friday, as I showed you. The market is bullish overnight. Additional economic stimulus. Market is hoping for additional economic stimulus after Biden takes office. Emergency declaration announced by Prime Minister Suga for Tokyo. I love his name, Suga. Asks people to stay home and refrain from going out at night to dine and drink. Does that sound like March of 2020 to you? It sure does. And what about Los Angeles? What about California? What about New York right now? This is bad. Authorities have little power to enforce anything like the kinds of lockdowns seen in some other countries. But I'm telling you, folks, with this unemployment number that I showed you, this is bad. This contraction is bad. Now, Democrats fully in control of Washington. Wall Street is anticipating, which is why the market is bullish right now, Biden administration and Congress will try to deliver $2,000 checks to most Americans, increase spending on infrastructure, and take other measures to nurse the economy. Investors are largely looking past the current political ugliness, that's a smart idea, and the pandemic's acceleration around the world, and are focusing instead on prospects of an improving economy. Well, here's the problem with that, folks. The reality is the economy is not improving, and viruses and the virus load and the people getting infected is just climbing climbing, climbing, climbing. So my fear is that the market is going to start pricing in some of this downside, especially if Biden starts making a big deal out of it and calling for a mandatory lockdown and so forth and so forth. That may cause us to go back into the same type of economy we saw last March and April, although stocks like Zoom don't see that yet. Let me show you what I'm talking about. And I'll check Peloton in a second too. But it's breaking down, and it doesn't look like people are too fearful of the stay-at-home environment coming back in. Plus, valuations are a little high. Let's see how Peloton is doing. I wanted to kind of get a look to see how the stay-at-home stocks are doing. Peloton is still moving higher, but remember, their estimates are higher and higher and higher. If Peloton breaks above the high, the 170, there's a good chance that fear level is going to really, really impact us. Now, in terms of the overall stock market, which is cooling off after that jobless claim report, the NASDAQ, I want to show you again momentum levels, folks. And I'm telling you right now, it's going to come and bite you in the butt. Don't expect big gains from the NASDAQ 100 right now. I want to show you the level, the momentum levels. Stocks trading above the 50-day moving average. We're still in that red zone, folks. And if we go long term, we're still in danger zone. What about stocks trading above the 200-day moving average? Wait till you see this. Look at this. Look at that. Highest level we've been to in 10, 11 years. So again, as far as the NASDAQ 100, the large cap FANG stocks, I'm expecting some selling pressure. I'm expecting this to curl forward. As far as interest rates, I'm expecting interest rates to start, especially long-term rates, to start ticking up or at least not going down. And bonds to continue trading lower. Also, put-to-call ratio is going lower, which is telling us that stocks are stretched out quite a bit right now. So right now, my fear is that market is going to start cooling off a bit more than people are anticipating, at least till Biden's presidency takes place and he announces that there's going to be more aid. Because right now, there just doesn't seem to be a catalyst that can prop the market substantially higher outside of small caps. And there's going to be a rally in renewable energy, disruptive tech, and small caps. That's going to happen because there's going to be huge infrastructural changes that Biden is going to be announcing. So that's going to be a run. But as far as large cap tech, as far as the S&P 500, as far as the stocks that have been outperforming lately, the put-to-call ratio is telling us that the market is overstretched. The employment data is telling us that that the COVID is starting to have a major impact on the economy again. And again, I'm not happy with momentum levels that I'm seeing. So momentum levels, put-to-call ratio, and the economy and the bond market is telling us we may be slowing down in terms of large cap growth. Keep that in mind. And if you're in Amazon and Nvidia and those stocks, cool off a little bit. Take some money off the table. Put your money into index funds, or start moving into small caps like Russell 2000. Let me show you this. See, it's up, it's higher, it's doing. Look at this thing. It's closing at the high yesterday, breaking out. Look at that, all-time highs. Whereas QQQ, it's a little higher, long term, just made a high, but again, momentum and divergence. Look at that. Divergence just keeps on moving low. Lower highs, higher highs. I'm not happy with that. Also, look at where this is. It's higher, but look where the Russell is right now. Big difference. Big difference. Look at that. And it's not diverging. Major difference. Now, I know it's Friday, but I've got something really big for you. Something important. 2020 was a volatile year, to say the least. And who knows what 2021 will bring, right? I mean, we can anticipate, but we don't have a crystal ball. I actually do have one of my offices in the office, but you know what I'm talking about. Luckily for you, I've come across a trading strategy that could bring you some calm during the market storm. And that's what we want in 2021, especially after this crazy 2020 that we've been seeing. It's called trophy trades, and over the course of the last 20 years, the man behind the strategy has won 206 out of his 213 trades. That's crazy good. Imagine taking 213 trades and winning on 206 out of them. In fact, the trophy trade system gave Chuck, 10-time trading champion, and his followers a chance to earn $13.5 million during that period. Now, that's why I call this guy the heavyweight trading champion. This guy's on fire. All you've got to do is click on the link below to learn how you can access these trades. Folks, I think out of the last 25 trades, don't quote me, but I think 25, 26, I think he had one loser. Out of 23 trades, out of 23 trades, he had one loser. He's got a win rate of 95%. Chuck knows how to make money from the markets. And that's why he's the 10-time trading champion. Duh. Folks, I love Chuck. I can't say enough good things about him. He's the heavyweight trading champion. You got to learn about these trophy trades. Don't cheat yourself out of potentially making substantial money out of this with a high win rate. All you got to do is click on the link below to learn how you can access these trades. Do it now. Make 2021 the best year ever. And have an amazing weekend. Bye, everyone.